Today is March 2nd, 2026, and we are watching the Strait of Hormuz close to shipping traffic after the most significant military escalation in the Middle East since the Iraq War. Iran's Supreme Leader, Ayatollah Khamenei, is dead. Over 1,000 targets have been hit. 3 U.S. soldiers are confirmed killed, and 20 million barrels of oil per day, representing 20% of global supply, are now trapped behind a shipping choke point that Iran's Revolutionary Guard has declared closed. Oil analysts are forecasting prices could spike $5 to $10 when markets open, with some calling for triple-digit crude if the strait stays shut. This isn't just a geopolitics story. This is an inflation crisis, a recession risk, and a portfolio shock rolled into one. I'm Roxanne, and over the next few minutes, I'm going to show you exactly what this means for your money. Before we dive deep into the numbers, let me be clear about what this channel does. We analyze economic impact, not politics. We cite sources, verify data, and focus on how global events translate to financial outcomes for regular people. Everything you're about to hear has been cross-referenced with official sources including Reuters, Bloomberg, the U.S. Energy Information Administration, and exchange data. Let's break down what just happened and what it means for markets opening Monday. The timeline matters because this escalation happened fast. On Thursday, February 27th, the U.S. and Iran were in indirect talks in Geneva, with Oman's foreign minister saying they had made significant progress on nuclear negotiations. Technical talks were scheduled for next week in Vienna. By Saturday morning, February 28th, everything changed. The United States and Israel launched what they're calling Operation Epic Fury and Operation Roaring Lion, a joint strike targeting over 1,000 locations across Iran. Israel dropped more than 1,200 munitions across 24 of Iran's 31 provinces. The targets included Iran's Supreme Leader, Ayatollah Ali Khamenei, who was killed in strikes on a leadership compound in Tehran. Iranian state media confirmed his death on Sunday morning. The U.S. Central Command reported striking ships, submarines, missile sites, communications infrastructure, and command centers of Iran's Revolutionary Guard Corps. President Trump stated that 48 Iranian leaders were eliminated and that 9 Iranian naval ships were sunk, some of them described as relatively large and important vessels. Iran's chief of staff, Abdolrahim Musavi, was confirmed killed, along with multiple senior security officials. 3 U.S. service members were killed in Iranian retaliatory strikes, with 5 seriously wounded. These are the first confirmed American casualties since operations began. Iran's response came within 4 hours, which indicates this was pre-planned. They launched coordinated attacks on Israel and U.S. military bases across 8 countries: the United Arab Emirates, Bahrain, Kuwait, Saudi Arabia, Iraq, Jordan, Oman, and Qatar. At least 9 people were killed near Jerusalem, with over 100 injured in Israeli cities. In Iran, the reported death toll from the strikes stands at 201, with 747 injured, according to Iran's Red Crescent Society. The scope of this conflict is unlike anything we've seen in the region in over 2 decades. Here's where your wallet comes in. The Strait of Hormuz, the narrow waterway between Iran and Oman, is now the focal point of global economic risk. According to the U.S. Energy Information Administration, 20 million barrels of oil moved through that strait every single day in 2024. That's roughly 20% of global petroleum consumption. The strait is only 33 kilometers wide at its narrowest point, with shipping lanes just 3 kilometers wide in each direction. On Sunday, a European Union naval mission official reported that vessels in the region were receiving VHF radio warnings from Iran's Revolutionary Guard Corps, instructing ships not to pass through the Strait of Hormuz. While Iran has not formally confirmed a closure order, ship tracking data shows oil and gas shipping has largely paused, with only a trickle of vessels moving out and none entering. Let's talk about what this does to oil prices. Brent crude closed Friday at $72.48 per barrel, up nearly 2.5%. West Texas Intermediate closed at $67.02, up almost 3%. But that was before the weekend escalation. Energy analysts I've reviewed from Rapidan Energy Group, Vanda Insights, and MST Marquee are forecasting an immediate spike of $5 to $10 per barrel when futures trading opens Sunday evening at 6 p.m. Eastern. Bob McNally from Rapidan Energy, a former White House energy advisor, said, quote, "This is the real deal," and warned that if Iran makes the strait unsafe for commercial traffic, oil could spike above $100 per barrel. The nightmare scenario that analysts are pricing in is not just Iranian oil being offline. Iran produces about 3 million barrels per day, making them the fourth largest OPEC producer. The real risk is the entire Gulf being cut off from global markets. Saudi Arabia, Iraq, UAE, Kuwait, and Qatar all depend on the Strait of Hormuz to export their oil. According to the EIA, 84% of crude oil moving through the strait in 2024 went to Asian markets. China, India, Japan, and South Korea accounted for 69% of all crude flows through Hormuz. These economies run on Gulf oil, and if the strait stays closed, there's no easy alternative route. Some pipeline capacity exists, about 3 million barrels per day, but that's nowhere near enough to offset 20 million barrels daily. Saul Kavanik from MST Marquee told clients that if Iran feels they face an existential threat and successfully blocks the strait, quote, "This could present a scenario 3 times the severity of the Arab oil embargo and Iranian revolution in the 1970s, and drive oil prices into triple digits while LNG prices retest the record highs of 2022. That's not hyperbole. The Strait of Hormuz also handles about 20% of global liquefied natural gas exports, mostly from Qatar. If that stops flowing, energy prices don't just rise. They gap violently upward on fear alone, according to Ali Vaez from the International Crisis Group. So what does higher oil mean for you? Let's be specific. Every $10 increase in crude oil translates to roughly 25 cents more per gallon at the pump. If Brent goes from $72 to $95, you're looking at gas prices jumping 60 cents per gallon almost overnight. For the average American household driving 12,000 miles per year in a vehicle getting 25 miles per gallon, that's an extra $290 annually just for fuel. But it doesn't stop there. Higher diesel costs mean higher shipping costs, which means higher prices on everything from groceries to electronics. The inflation that central banks spent 2 years trying to crush could roar back in a matter of weeks. The stock market is already pricing in volatility. On Friday before the strikes, the S&P 500 dropped 0.4%. The Dow fell over 1%, and the Nasdaq lost almost 1%. The VIX, Wall Street's fear gauge, jumped over 6%. Analysts expect Monday's opening to be heavily impacted by the weekend developments, with futures likely gapping down as traders shift to risk-off positioning. Historically, when Middle East conflicts escalate, markets see initial sell-offs of 3 to 5% before stabilizing if the situation doesn't worsen. The key question is duration. If this is a short, sharp conflict that resolves within days, markets recover quickly. If we're looking at weeks or months of disrupted energy supplies, the economic damage compounds. Let's talk about sector rotation, because not everything loses in this environment. Energy stocks rallied going into the weekend, with the sector reaching recent highs as oil prices climbed. Defense contractors historically perform well during military conflicts, but the big winners in times of geopolitical crisis are safe haven assets. Gold hit over $5,200 per ounce, up more than 22% year-to-date. Silver surged past $94, testing multi-month highs. These aren't speculation plays. These are fear trades. Investors are fleeing risk and piling into assets that hold value when everything else falls apart. The US dollar typically strengthens during global crises as investors seek safety. But this time, there's a twist. The dollar's share of global reserves is at a 32-year low, according to recent data. Central banks have been diversifying away from dollars and into gold at record pace. The Fed is also in a tough spot. If oil spikes and inflation reignites, they can't cut interest rates to support growth. If they keep rates high to fight inflation, they risk pushing the economy into recession, while households are already squeezed by higher energy costs. It's a policy trap with no good options. For China and India, this is an immediate energy security crisis. China imported 1.38 million barrels per day of Iranian crude last year, about 13% of its seaborne oil imports. Nearly half of India's crude oil and 60% of its natural gas supplies move through the Strait of Hormuz. Both countries have strategic petroleum reserves, but those are measured in weeks, not months. If the strait stays closed, they'll be forced to bid up alternative supplies, driving global prices even higher. Now, let's address what could make this less catastrophic. Trump has shown willingness to de-escalate in the past. There were nuclear negotiations happening just days ago. Iran's new interim leadership might choose a different path than confrontation. OPEC Plus is meeting on March 1st and could increase production to offset supply fears, though many of those producers are the same Gulf states that just got hit by Iranian missiles. The Strategic Petroleum Reserve in the U.S. holds about 415 million barrels and could be tapped if prices spiral. But as Kevin Book from Clearview Energy Partners warned, in supply crises, duration matters. A full Hormuz closure could outstrip what strategic stocks can offset. The insurance market is already reacting. Ship insurance rates for transiting the Strait of Hormuz have spiked from 0.125% of ship value to between 0.2% and 0.4%. For very large crude carriers, that's an extra $250,000 per trip. If insurers stop underwriting Hormuz transits entirely, it doesn't matter if the waterway is technically open. Tankers won't move without coverage, and the effect is the same as a physical blockade. Here's what to watch Monday. Oil futures open at 6 p.m. Eastern Sunday. If Brent gaps up $10 or more, that tells you the market is pricing in sustained disruption. Stock index futures will give you an early read on sentiment. Watch whether the S&P holds above 6,770 support. A break below that level signals real technical weakness. The VIX spiking above 25 would indicate panic is setting in. Gold breaking decisively above 5,300 confirms safe haven flows are accelerating. Silver holding above 95 could push it toward the psychological $100 level that attracts momentum traders. For regular investors, this is not the time to panic sell, but it's absolutely the time to review your portfolio. If you're heavily concentrated in high-growth tech stocks that thrive in low-rate, low-inflation environments, understand that those could get hit hardest if energy prices force the Fed to keep rates high. Conversely, if you have zero exposure to energy, commodities, or defensive sectors, you're not positioned for this shift. Diversification isn't just theory. This is exactly the moment it matters. The broader economic picture is also worth considering. The U.S. budget deficit is running $697 billion in the first 4 months of fiscal 2026. Net interest on the debt is over $1 trillion annually. There's $9.6 trillion in debt maturing in the next 12 months. Higher interest rates driven by inflation make all of that worse. The government's ability to finance itself gets more expensive, which either means more inflation from money printing or fiscal constraints that slow growth. Neither is good. Let me be clear about the bearish case, because I don't sell hopium here. This conflict could de-escalate as fast as it escalated. Diplomatic channels are still active. Iran's interim leadership might choose survival over retaliation. The U.S. could pressure Israel to hold fire while negotiations restart. Oil demand globally has been softer than expected, with the EIA forecasting oversupply through 2026 before all this happened. If the strait reopens within days and production comes back online, prices could retreat just as fast as they spiked. Markets have priced in geopolitical risk premiums before that never materialized. But here's what the data actually shows. We have confirmation that Iran has closed or severely restricted passage through a choke point handling a fifth of global oil. We have confirmation of the largest military strikes on Iran since the 1980s. We have confirmation of multi-country retaliation from Tehran. This isn't speculation, it's happening in real time. The insurance market, the tanker tracking data, and the analyst forecasts all point the same direction. Supply disruption is real, duration is unknown, and markets are going to react. I want to know what you're watching Monday. Are you positioned defensively? Are you adding to energy and commodities? Are you staying in cash? Drop a comment and let's have a real discussion. If this analysis helped you understand what's coming, hit that like button. Subscribe if you want economic impact breakdowns without the hype. Share this with someone who needs to understand how geopolitics translates to their portfolio. Bottom line is this. We are in the early hours of a major Middle East conflict with direct implications for global oil supply, inflation, interest rates, and market stability. The Strait of Hormuz choke point is the critical variable. If it stays closed, we're looking at oil potentially spiking to triple digits, inflation reigniting, central banks trapped between growth and price stability, and stock markets facing sustained volatility. If it reopens quickly, the damage is contained to a short-term shock. Monday morning will tell us which path we're on. Stay informed, stay disciplined, and I'll see you in the next breakdown.